Alright, welcome back. Let's talk about venture capital this week. If you missed my video on private equity last week, be sure to check that out on the upper right corner. Again, everything I say is a generalization, so let's get into it. Venture capital is a form of private investing. They invest in startups by providing capital and guidance. Venture capital follows a power law. A small number of successful investment will be responsible for the majority of the return for a venture fund. Raising VC money can be a huge seal of approval for your startup and a big milestone, but in exchange, you have to give up ownership in your creation. Those of you who have watched Shark Tank should understand exactly how that works. This is the Sand Hill Road. It's a road in Menlo Park, California in the Silicon Valley. That's where many prominent venture capital firms are headquartered. So it has become a symbol of VC industry, just like how Wall Street is tied to the stock market and K Street in Washington, D.C. is tied to lobbying. In terms of entry points, entrepreneurship will be one, because there's no better way to prove that you have the experience to assess whether a startup will succeed or fail, and whether the founder has what it takes. Investment banking and management consulting will be another road, because you sold your soul for exit opportunities, so you deserve a shot at any high-profile career path, which includes venture capital. Product people, that's your product manager or engineers within the tech firm. Now, they have the right skills to know whether a product can solve a business problem, or they know ways to fix a product. I have seen some sell-side equity research people covering growth sectors get into VC as well. And there's also MBA, because you paid for the optionality. But it's very predicated on your pre-MBA work experience and how you approach the recruiting during your MBA. One big difference between VC and the other two members of the Holy Trio is that the Tier 1 VC firms have consistently generated the majority of the returns of the entire industry. The reason is VC investing is very relationship driven, and the startup founders want guidance from people like John Doerr, Doug Leone, or Bill Gurley of the world. So the dynamic is the winner tends to keep winning. And the implication for you is if you're dead set on only wanting to work for Sequoia, Kleiner Perkins, or A16Z, you can't just bring your A game. You gotta bring your AAA game because it's going to be insanely competitive. I'm talking about Stanford Graduate School of Business competitive. On a day-to-day basis, your tasks could include reviewing startup pitch decks, number crunching, and writing investment memos, supporting portfolio companies, and then as you become more experienced, you'll graduate to sourcing investment opportunities and finally fundraising. In terms of the org structure, you have the analysts and associates. They crunch numbers, they analyze companies, they write investment memos, they look at pitch decks, basically anything the seniors don't want to do or don't have the time to do. And then you have the principals. They still perform diligence, but they're more involved in sourcing investment opportunities by building and leveraging their network. To meet with startup founders under these buzzwords:
robotics, artificial intelligence, digital manufacturing, big data analysis, quantum communication, and Internet of Things.
And they're also very hands-on in supporting their portfolio companies. Finally, you have the partners. They're the most senior people. They have the final say on whether to make an investment, and they have big stake in the VC funds so that they share both the upside and downside of the investment decision. They're also very involved in fundraising. Every VC firm has a managing partner who oversees the strategic direction of the firm itself. Average base and bonus, analyst gets paid on average $100,000, associate and senior associate $150,000 to $250,000, principal $250,000 to $400,000, junior partner $400,000 to $600,000, the partner $500,000 to $1 million. Venture capital firms also get paid carry, very similar to private equity firms. And the action's really in the carry, and that depends on the firm's size and fund success. Let me try to paint you a picture by mentioning some of the big dogs in the space. Doug Leone is worth $6 billion, and he invested early in ServiceNow, which is today a $80 billion market cap company. Bill Gurley is worth $8 billion. He invested in Series A in Uber. John Doerr is worth $13 billion. If you didn't know, he invested in Amazon and Google very early on, so no big deal. Unlike private equity, everything you look at in venture capital is by definition very sexy. You get to learn about the products and the businesses that are trying to solve the biggest problems of the future. VC is very suitable for the social butterfly type because you must be networking constantly to find the next Zuckerberg or SBF and beg them to take your money instead of your competitor's VC money. And of course, you won't know whether there's Zuck or SBF until afterwards. And VC is pretty decent work-life balance. And similar to private equity, VC is not secularly challenged because venture capital investing is very relationship driven. And that's especially true for the tier 1 VCs who have consistently created value for their investors. It's not at risk of being disrupted by robots. Similar to a hedge fund, you will always be on. People will constantly hunt you down to pitch you their startup or ask for intro to your firm's partners. Venture capital is fun, but it's still a big risk-taking job. Very topically, we saw Sequoia and Temasek taking a huge L on the FTX investment. Doesn't feel great to blow $150 to $250 million on an investment, does it? The exit opportunity for venture capital is pretty limited, especially if you have never done investment banking or private equity. And it takes a long time for your big payday, which is the carry, because venture investments take 7 to 10 years to play out. If it works out via a IPO or the business getting sold to a big tech firm like Microsoft, Salesforce, or Meta, it's always one of those. So you need to, 1, make the right investment. 2, wait. If you want to move to a hedge fund or a private equity firm, I hope you have done investment banking because you're going into a more fundamental focused role. And hedge funds and private equity firms are looking for someone with financial analysis skills, not some napkin math or finger in the air analysis. In terms of going into a hedge fund, I don't know anyone who has made that move. If you have done investment banking, it's doable. You will need to network and prove that you can do the job during the interview process. In terms of going to private equity, because you do VC currently, you probably don't want to do LBO anyways. So you need to rely on your investment banking experience to network into a growthy private equity investment style. The drawback will be the longer hours and the other negatives associated with the private equity industry. If you found this helpful, please hit like, subscribe, and hit the bell icon for future content. That's it for this week. I'll talk to you next week about the final member of the Holy Trio, hedge fund. Peace.